Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX Strategy at NatWest, and I'll be your host today. And I'm happy to be joined by Paul Robson, who co-heads G10 FX Strategy with me, sitting over in London, talk about all things European currencies and a quick update on the dollar as well. So, Paul, thanks very much for joining.
Well, as ever, thanks very much for the invitation. Very much looking forward to running through this week's events and having a look into our crystal ball about what we should be expecting.
Yeah, so I definitely want to ask you about some of the themes in European markets this week, but I think it's worth touching on the dollar at the offset because, as you mentioned on the pod last week, Paul, it's really a dollar world right now, and it feels like all currencies are marching to the beat of the US dollar. And I think the big question that we've been asking ourselves, and we've been watching the economic data here in the US, is when will tariff impacts start hitting the data? And will we start to see any signs of tariff-related front-loading of purchases and activity starting to show up in the economic data? And we're recording this on Thursday before the non-farm payrolls report on Friday. And so those of you who are listening to this will have a lot more information on the state of the labor market than we do. But we're starting to see, at least in the past week, some of the economic data have taken a turn a bit lower here. Now, it's difficult to say which of these factors is really the larger driver here. Is this something that we're finally seeing some of the tariff impacts, some of the uncertainty for businesses and for consumers starting to hit the data a little bit more? You saw in the survey data from the ISMs, for example, a bit of an uptick over the last couple of weeks in initial jobless claims, suggesting maybe some slight uptick in layoffs, for example. Or is this just natural, some slowdown because of the massive preloading that we saw because of tariffs? It's only natural to think that because there was a big front loading of demand, whether it be for imports or for business investment, that would only be natural to see some of those economic data come off a little bit. So it's difficult to say which of those factors is maybe driving a little bit more here, but it certainly feels like the sort of immediate term economic data is maybe giving us a slightly worse picture than it certainly was last month. And now some of this should be expected, but I do think that this feeds into a broader dollar negative outlook, whether it be the cyclical backdrop. I think it's right to still say that the cyclical backdrop better now than it was a few months ago because of the de-escalations in tariffs. But at the same time, we've been watching this data, expecting some give back from the first quarter, strength in some categories. Had the trade data this week showing a big drop in imports, for example, as just one example of how this data is evolving. So continue to think that cyclical picture certainly evolving here. Some of the recent data have been a little bit softer, and the structural challenges for the dollar, I think, still very much there. And we've had the dollar weakening against the majors this week, including against European currencies. And Paul, I want to bring you in here. Let's start with the euro area because we just had the ECB decision today. What did you make of the decision from the ECB?
In terms of the ECB meeting, I always start with the price action. That normally gives you a good steer on how markets have seen the decision. Both euro dollar and euro sterling were higher through the press conference. So I think that shows you there was something slightly more optimistic, slightly more hawkish in what we heard, because the market was fully priced for a 25 basis point cut in the policy rate. So I think markets have been discussing whether the ECB is a terminal, the landing zone for its easing cycle at neutral, and it's certainly in the range that the ECB has given. But if the euro has reacted, it feels like it was a sort of hawkish cut, if you like, and that's important. I think also optically, it's quite interesting that other central banks, maybe the Fed ultimately at some point, maybe still continuing to ease policy, but the ECB perhaps signalling that they're done. And that was, I think, the key takeaway from Lagarde. She was, and the forecast as well, she was made the point that inflation is at 2% target. Inflation expectations are well anchored around 2%, and inflation over the next couple of years or in 2 years' time will be at 2%, in line with the target, so price stability. So why would you want to take policy further below neutral if you think that you're meeting your main mandate? And I think that was the key takeaway. Of course, it's an uncertain world. You talked about sort of tariffs and the US data, and that's still with us, isn't it? Over the weekend, it was, Donald Trump had sort of escalated again in terms of steel and aluminium tariffs. The talks between the US and the EU continue. Let's see where they come out. I think markets are probably expecting there'll be a deal at some point, but these things can rumble on for longer, have a disinflationary impact. And this is the point that Lagarde actually made, that any escalation would be having a deflationary impact on growth, because Europe has, I guess, more to lose in this round of trade discussions. And as long as they don't retaliate significantly, you're not going to get higher inflation on imported goods. So key takeaway, very much a hawkish cut, and perhaps ECB is done.
So how is this impacting how you're thinking about eurodollar here? Because we've seen certainly on the dollar side, we've seen relationships between front end yield differentials and dollar crosses broadly have weakened a little bit here. How are you thinking about euro here, with the ECB seeming to maybe suggest that their cycle, as you mentioned, might be finished here?
Yeah, it's hard to see it as a negative for, say, euro dollar. If, and I talked about the optics, if the ECB has finished cutting and other central banks may still be cutting, or yet to sort of cut more aggressively. I'm sort of thinking about the Fed later on in the year, maybe into 2026. That, and as you say, rates haven't been a great predictor of currencies recently, but the fact that euro dollar has rallied today just shows you it is important. So it does provide support. I'm not sure it's going to be a big enough driver to move euro dollar significantly higher, but there's some other things around this that are important. Maybe we're moving through, or quite beyond peak pessimism about the euro area growth outlook. It looks to have stabilised. You've got real disposable incomes probably growing. You've got the opportunity for savings to be run down. You've got lower energy prices. That really does matter in Europe. Energy prices. So I was just checking my energy bill recently, and they're still 100% higher than they were before the sort of Russia-Ukraine situation. So energy prices lower would matter, and of course, at some point you might get some kind of EU-US trade deal, which would be, I think, more supportive of euro dollar. But as we've discussed in recent weeks, haven't we, Brian? And you touched on about structural cyclical weakness, is capital leaving the US, and if it is, there's still a lot of uncertainty about that. Where perhaps might it be going, and into what assets? And I still think that's going to be the dominant theme for euro dollar. The FT this morning actually had it as their sort of headline about capital leaving the US, and the euro area seems to be one of those places that that might be the destination, and if it is, that would matter. I still think FX reserve diversification. We've talked about large amounts of FX reserves, or 12 trillion, and just under 60% are held in dollars. That used to be like 75 a couple of decades ago, but small changes, shifts in appetite to hold dollars has quite a big impact on euro dollar over the short term. So I'll be watching that, but we're holding to our view that euro dollar is sort of trading up into the higher end of 115.20 by the end of the year.
Yeah, super interesting. You mentioned the energy prices as well, because it's not just that energy prices have fallen, they've fallen in dollar terms, and the dollar has weakened against a lot of these currencies. And so you think about the inflationary impacts or disinflationary impacts in some cases that, other economies, non-dollar economies, are maybe feeling a little bit more of that relief. That's basically the opposite of what we saw in 2022 when you had a surging dollar and the Russia-Ukraine war really pushing energy prices higher as well. And so it was sort of a double whammy. Now it feels like there's maybe a bit more relief coming, but hopefully your energy bills, Paul, will soon be reflecting those changes. Now I want to go to your home in the UK. Catherine Mann had an interesting speech this week talking about QT and the modalities there. Just wanted to ask you about how you're thinking about Bank of England and QT, and how that's feeding into what you're thinking for sterling here.
Yeah, as you say, it was an interesting speech. It was a relatively quiet week here in the UK in terms of events and the data. I think markets were waiting for the ECB and the payroll report that was coming at the end of the week. But the fact that she chose to talk about it, I thought was interesting. For those that maybe not follow the sort of quantitative easing story from the Bank of England in a lot of detail, the MPC and the Bank of England have a decision to make come September about whether they should continue with it. This is unwinding of the run up in the balance sheet during the global financial crisis and then COVID as well. And it's about running down the balance sheet to make sure that the Bank of England is less exposed to shifts in interest rates, and it's also about providing reserves to the banking sector more by repo facilities rather than how they're doing it at the current time. So it's important to separate that from inflation targeting, inflation mandate. That's done via the policy rate. That's why people like myself and you spend so much time thinking about short end rates rather than long end rates when it comes to the currency. How it is important, though, I think, is that when we talk about fiscal policy in the UK, perhaps being a risk to sterling's participation in any sort of dollar weakness theme about can it appreciate against the euro, because we think that fiscal policy will be a greater focus for markets come the autumn. We have a autumn budget. There is a lot of new bonds being issued by the debt market office here in the UK, and so are lots of other countries issuing a lot. So just that competition for the demand for sovereign debt sort of matters. And so if the Bank of England was, for example, to stop its QT program, that would probably it would reduce the amount of sort of supply of bonds in the market. So what they're doing is they have two parts. They run it down their balance sheet about 100 billion a year. It's been a bit different this year, but next year from October, it will be natural runoff as bonds just redeem. That's about 50 billion. Active sales are 50, so 100 billion. And that's in the context of 300 billion of gross issuance by the Treasury and the DMO here in the UK. So it's a sizable amount. You can't just compare them like for like because there's redemptions on both sides. But if you were to cut that, either just stop active sales, then 50 billion less would matter. And therefore, if you were to do that, maybe it reduces some of the risk premium in sterling because of fiscal policy. I think that they will continue it because it's this separation of monetary policy and QT. This is about balance sheets, as I said, interest rate sensitivity. It's about reserves. If they were to change it, it might show that they were more sensitive to fiscal policy than that they perhaps want to signal to the market. But going back to that Mann speech, it was interesting that she was talking about the cumulative impact of it, and maybe she's a little bit more likely to vote with her colleagues to talk about reducing QT. And so maybe it's about a twist. Maybe they'll move down the curve a little bit in terms of issuance, but that will be something we'll be focusing on late summer as the sunny weather it seems to be long gone at the moment.
Yeah, Paul, can I just ask you a quick follow up there, just on the currency? And I just want to make sure I've got this right myself. That you're thinking about these questions, or maybe not questions for today, but you're thinking about this in that fiscal monetary mix, right? That how this impacts sterling could be if it has impacts on long term yields. We've seen periods where long term yields have been impacting sterling more often in the negative direction, where you've had rising yields in that direction. Is that how you're thinking about it here? Is you're trying to find that monetary and fiscal mix here?
Yes, it is. Maybe you should have answered your own question. I thought you did a much better job of answering your own question. But yes, that's exactly how we're thinking about it. It's that sterling being the release valve for fiscal risks. We've seen it a couple of times this year already in January and in April, that when long-term interest rates go higher, the currency weakens, so the correlation flips, and that becomes a little bit more malign in rather than benign in terms of the outlook. So yeah, it's definitely a risk event we're watching. I don't think over the next couple of months it will be a key driver of the currency. I still think one against the dollar, it will be that capital flow story. For sterling directly, it will be about short end rates and what the Bank of England signals and hints about future interest rate changes.
That's great, Paul. Super interesting. And I appreciate the conversation, and we should probably end it there. So thank you, Paul, once again for joining. And to our listeners, thanks very much for listening. If you enjoyed today's podcast, please consider giving it a like and also subscribing to the channel so that you can get our latest podcasts the moment they're released. Thanks very much.